I'm Doug McKenzie.
And I'm John Ward.
And we're the co-hosts of the ABCs of IBC podcast.
Come join us as we share our unique perspective on the infinite banking concept as the creator, Nelson Nash, intended.
Welcome back, everybody, for another fabulous episode.
Yeah. Good morning, Doug, and good morning, or whatever time of day it is, to everyone listening. Thanks for doing so.
Yes, indeed. Well, we are going to talk about something that we think is interesting today. I think we do that every week.
Yeah.
But we're going to talk about timing, which is something that, we want to just first stipulate that we're not, trying to predict the future or offering financial advice here. But we think that right now is a really good time to buy life insurance. I also want to stipulate that now is always the best time to buy life insurance, just because of the time value of money and what you can buy gets worse as you get older. So obviously, right now, John and I would say is quite literally always the best time to start a policy. So if you're thinking about it, now's the time.
Yep.
But we wanted to do this episode because we've looked at historical trends of, dividend crediting that insurance companies have paid out. They tend to follow trends of inflation and bond yields. And right now, we are kind of in a bit of a valley, wouldn't you say, John?
Oh, yeah. Yeah.
They've been declining for a long time. And we've had one major insurance company just announced a dividend rate increase, which could bode well for the market, the insurance market in general.
Yeah. Yeah, and there is a little bit of a lag time with the shift in bond yields and what the market is bearing right now. So, they've already, insurance companies already own long-term bonds. And so those have to come to maturity too. But then they're good investors. And, obviously if you're buying new bonds today, the interest rates are much higher. And, again, like Doug said, that we're not really trying to, it'd be nice to predict the future. And then we'd be rich. But
yes.
And then anybody listening would share it with you, and you'd probably be rich too. But, what we can look at is just like a bull market in the stock market means, that things are going up in price. There's been a bull market in what we call, bonds or U.S. treasuries here, obviously in the U.S., is we've had prices run up. In the way the interest rate works on that, the higher the cost of the bond, the lower the interest rate, which in some ways works out well, and in some ways, it doesn't. But let's just say that, okay, we've had a bull run. We got close to 0% interest rates on some of these bonds. And then now we're in a bear market, which is like the stock market was when things are going down in price. And when the bonds go down in price, the interest rate return, the redeemable interest, goes up. So we're it looks like a shift. We had the peak, and now we're going to have the valley. And the valley means the prices are down, but the interest rates are up, which means that if insurance companies are investing in these things long term, which they are, then dividends probably, when they're paid, will be much higher than what we're illustrating even today.
Yeah. And that's exactly the trend, John. I mean, when you look at policies that were illustrated 10, 15 years ago, the dividend rates have pretty much just slowly slid down over the last decade or so, the dividend crediting rates. That being said, I've had a chance to look at some older policies, not that I've issued, but most of them performed quite well, not that far off from the non-guaranteed illustrated side. I was surprised by that. Insurance companies held up remarkably well over that, although they were below that. On the flip side right now, when John and I do an illustration for our clients, when we have that non-guaranteed illustrated side, that's all based on current dividend rates. And that's kind of what the insurance company is estimating that they're going to have as a surplus at the end of the year that they give back to the owners of the company, which is you and me and anyone else out listening there that has a mutual life insurance policy. And like John said, when they are buying bonds, insurance companies don't trade bonds. They buy them and they hold them to maturity. So it's a different animal than most of us are used to. And so that's why John was saying that we lag. They lag that a little bit on the dividend rates. So you're not going to, I know that bond interest rates have been higher for a few years now. They're not going to immediately adjust to that because they're still holding bonds that might expire out, over the next few years that have very low interest rates, but they've been buying those higher interest bonds as well. And so we start to see that slow adjustment to that, slow and steady, to where that yield is now allowing them to have more of a surplus in their operating budget, which then comes back to the policyholders. And as anyone listening to this probably knows, but if you're new and this is your first episode, what we set up for our clients, the vast majority of the time, is for the dividends to be reinvested to buy paid up additional insurance, which is quite literally buying another mini insurance policy within that policy. So it has this compounding effect. And the larger the surplus, the more insurance you're going to buy within that policy, which is going to grow both cash value and death benefit. And so John and I, we've been talking about this, looking at the historical trends, following a trend of increasing rates, and you're looking at usually a couple years after, you're going to start to historically, we've seen rising dividend crediting rates. Yeah. And so that's why we're bringing this up.
Yeah. And, many times you've said, if you haven't read Becoming Your Own Banker by R. Nelson Nash.
If you haven't read Becoming Your Own Banker, you should read it.
Yeah. And I think it's been said that, if he was to rewrite this book or had rewritten it, that he might not have included all these illustrations, all these tabular numbers, and, and then... And one of the reasons is, people get stuck in not really thinking about the concept of becoming your own banker, this infinite banking concept.
Yeah, that's a great point.
Yeah, they're actually stuck on, let me get the math straight.
I've had so many people get stuck on that, John.
Yeah, well, I mean, rightfully so. It's right there, and he's explaining it, and he's trying to share that this is how it's going to work. And so people think those are the numbers. And then if Doug and I do an illustration for people, we're doing them off of a lower dividend scale today. We're at the historical lows.
Much lower than when he wrote that. Yeah.
Yeah. And so, the idea is that, if you get in now, you're at likely at the lowest end of the dividend scale, and the numbers are
this era. Yeah.
And so what we're projecting in these illustrations, or depicting, whichever way you want to put it, is we're depicting what today's rate is, a payout. If that was your anniversary, say in year one, this is what the actual growth would be. And then they take that same rate and they project it out across the whole policy.
Until 121.
Yeah, exactly.
And that is quite literally projected on the lowest rates I think ever seen in history.
Oh, yeah.
In the U.S.
Well, at least that I know of anyways.
I don't know
I
of
have
any
like 34,
0%.
35 years of history that I can look at, and it's clearly the lowest. I mean, it might be 0.1% difference. I've seen like 5.1 and 5.2. I mean, really, but that's the bottom.
Oh, well, I mean, like compared to a couple years ago, which is essentially where the current, you know what I mean? Yeah. We were down at almost a 0% interest rate, and I'm saying I don't think And because we're basically, those numbers are projected off of those numbers.
Yes.
Do you know what I mean?
I hear you. Yes.
And so I don't
Exactly.
think that in the history of the U.S., I don't think that we ever got down to almost 0%. I don't think that that's happened.
It's
So
funny.
we're in a
Yeah.
new situation here.
I like to say that, I was in the mortgage business in the early 90s. I don't know if I've shared this, but anyways, if I have, it doesn't matter. And when I first got into the business, I was, getting educated and so forth and what have you. And I was in the conference room, and over near like a bookcase was this stack of like marketing slicks, 8.5 by 11s that said rates below 10,
Oh my God.
Yeah, it was a big deal because, that was, again, early 90s. And of course, we had high interest rates pretty much through the 80s.
Well,
right?
my aunt and uncle, they were telling me they got their first condo in the 80s, I think out in LA, and they had like a 14% interest rate on their mortgage, which is kind of hard to fathom.
Yeah. And so, I got my first mortgage, and we locked it in at 6.88 when we were having a house built. And
So that was like awesome.
Yeah, well,
Yeah.
like literally, it went from 7 to 6.88 or 6 and 7/8 one day. And, I'm a mortgage officer, and I think I know something, right? If I could predict the future. And my wife said, geez, I think we should lock in. And I said, I think we might go a little lower. Well, we locked in because, you got to listen to your wife.
Yep, smart man, yeah.
I kind of had already learned I better listen to her, and she's usually smarter than me. So anyway, she
Amen, yeah.
she was right, because literally the rates from, we locked in for 60 days, and the rates went from 6.88, I think it was only like one day, and went up to 8.5% by the time we were ready to close. And literally, if we didn't close in like 2 days, we were going to lose the rate lock, and we would have had to get stuck with the 8.5%, and literally wouldn't have been able to buy the house that we had, had built for us.
Sure.
Because we would no longer have qualified at 8.5%.
Yeah.
As we would have qualified at the 6 and 7/8. So it's that's the power. But we're getting a little off track. But that was
Yeah, it's interesting though, and I mean, again, we're not soothsayers. I wish we were, but insurance companies operate in a very, like we've talked about, very differently from banks.
Yes.
John and I were talking about this before. They're not being put in situations where they're having to sell a bunch of bonds at a loss to create liquidity. They have, they just don't practice fractional reserve banking, so they have 100% of assets on hand to cover liabilities, and they
the insurance company.
The insurance company,
yeah, exactly.
not the bank, not the bank.
Yeah, exactly.
No. And so they almost, insurance companies have a lot of different assets on their books. A lot of them hold real estate, some stocks, but it's primarily long duration, very safe, high rated bonds. They're not getting into junk bonds. They're mainly buying like treasuries and, direct municipal bonds issued out by some other countries. So they hold these to maturity, and it naturally follows that if the majority of the income is coming from the interest gained on these, then if they're getting a higher interest rate, they're going to have more money to go around.
Yeah.
And it is very reassuring to see how well they've done in the last decade, given, these low interest rate environments. None of them have cut their dividend. All of them have paid far above the guaranteed rate, with the exception of like Ohio National or some other companies that happen to demutualize. But the vast majority of the companies and the ones that John and I work with have weathered that phenomenally.
Well, think about it, right? If you bought a 30-year bond, right, 30 years ago, it was much higher than more recent bond rates have been, right? So, they've got a mixture of these terms, right? 10 years, 20 years, 30-year bonds, right? I don't know if there's 20 years, but anyways, I think it's important to try to, triangulate some things here a little bit, right? Which is we're talking about a cash warehouse, right? Becoming your own banker, putting things in a safer place, right? And we know that there's been some trouble in the banking world, Silicon Valley Bank, Signature Bank, so forth, right? And they also do diversify. They don't have everything in bonds, right? In fact, they own, as we've talked about, they own life insurance, which is what they call or referred to as one of the tier one capital assets, right?
BOLI.
Yeah, bank-owned life insurance. But the fact is that they have this, predominance of treasuries that is their liquidity, right? So if they have a so-called run on the banks like they did at Silicon Valley, they need to come up with the cash. And where do they come up with the cash? Well, if they've looking at their liquidity is these treasuries, and treasuries, were more expensive in the past when they bought them, which gave them these lower interest
like
rates.
0.5%.
Now they're cheaper because they've got a higher return. Well, then liquidity means a buyer and a seller, right? A ready buyer and seller that come together. And who wants to buy those overpriced bonds, right? So they get themselves in trouble. But back to insurance companies, they don't look at their bonds that they're purchasing is liquidity,
no,
right? They have other liquidity to pay out death benefits, to lend out in the form of loans, right? So I think that's a really important distinction and another reason why you want to become your own banker, right?
Yeah, perhaps it might be a good idea to have some of the best money managers in the world managing your money.
Yeah.
I mean, it's
on your team, right? They're on your team. They're your partner.
Yeah, they're your partner. They're managing. I mean, they really are. They've been doing it for 100 plus years, very successfully. Their track record is impeccable, speaks for itself. And yeah, I mean, look, John and I are, again, we really think that we're going to continue to see slow and steady increases on dividend payouts over the next few years. We don't think that it's likely that interest rates are going to drop heavily at any point soon. I don't think anybody really thinks that's going to happen. And that typically, historically, has spelled good news for insurance companies and their policyholders. So
that means you're buying more insurance, right? Because the dividends, if you're rolling them back into the policy, they're buying, if the number is bigger, the monetary number is bigger, then they're buying more insurance. And if you're buying more insurance, then you're building up your cash value, because your cash value in a bigger way, in a faster way, right? Because your cash value eventually has to meet the value or match the value of the death benefit. So the more insurance you're buying, the more the cash value is going to be available. And, obviously nobody's saying I want less money than more money, right? Because it gives you all these options.
And it doesn't cost you anymore. I mean, once you have that policy, the dividend rate, it comes through, right?
Yeah,
and,
that's a great point.
Yeah, and it doesn't, you're buying more insurance, doesn't cost you anymore. And yeah, the paid up additions rider is very powerful because it's instantly paid up. I mean, you're buying more insurance right then and there. And the compounding effect, when you look over the span of, a decade or more, becomes incredibly powerful. Even adjusting a percentage or two makes a very, very large difference in the long run, especially if you're looking out towards, drawing income in retirement years, or, looking to take a loan later in life. It becomes quite significant. So we always think that the best time to buy a policy is right now. And because that's the most powerful thing that you can do is get a policy at the youngest age possible. It really is. That's going to be the best return on your investment, right? But if you're someone that's listening and you're thinking, I'm still thinking about it, maybe in a few years. Well, in a few years would be a good time, but we think that right now would be a very good time to start a policy.
Well, yeah, and really what we're trying to do is have this money flow towards you, and that's what these policies allow for, is that it flows toward you and not away from you. And that's I think a wrap at this point, right?
Yeah.
Yeah, I'd love to hear from anybody that wants to reach out by email, questions. We're not talking about necessarily doing a policy. It just means, you'd like to engage, and we enjoy helping people along in their thinking.
Absolutely. Well, and if you're looking for a policy, we can help you with that too, obviously. So.
Yeah, we can do that.
Okay.
All right.
Talk to you soon,
Yeah,
John.
enjoy your day. Thanks. Bye, everyone.
Thank you for joining us for another episode of the ABCs of IBC.
If you enjoyed listening, please hit subscribe and leave us a 5-star review wherever you listen. It really helps. See you next week.
Bye.